the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements while Singapore shares inched higher as Asian markets traded mixed. So if we look at the Straits Times Index, it went up by 0.6% to 4,325 points at about 2:25 p.m. Singapore time, and that's with a value turnover of some 935 million Sing dollars seen in the broader market. Now let's take you through how the Singapore stock market fared on last check, or rather at the end of the trading day. The STI up 0.53% at 4,323 points. Now in terms of value turnover, we are looking here at 1.56 billion Sing dollars. Gainers outnumbered losers 258 versus 155. Top advances for today, we've got for you GMH USD, New Incorporation USD, and DBS. And top decliners, we have here F Point, SIA Engineering, and Yangtze Shipbuilding Sing dollars. Well, in terms of counters to watch, we do have LHN because the property management group said its co-living business, Coliwoo, has lodged a preliminary prospectus for a Singapore Exchange mainboard listing. Now, elsewhere from how global markets are reacting to a U.S. government shutdown that began today to how private surveys showed factory activity shrank in most of Asia's major economies in September, we've got more international headlines for you. And joining me on the line today is Dan Chang, trading representative at PhillipCapital. Dan, welcome back.
Hey, hi Tian Tian. Happy Wednesday. Thanks for having me.
Happy Wednesday and great to have you on board as well. A lot of things to break down today. Let's start with global markets. I mean, this U.S. government shutdown began today after lawmakers in Washington failed to come to an agreement, failed to reach a deal to avert this government shutdown. How are global investors taking in the news?
Yes, U.S. government shutdown is always headline grabbing. Yeah. But I think investors have seen this before in Trump's first presidential term. And the first reaction is usually a little bit of nervousness. And we'll see some short-term volatility in the stock market, especially the U.S. one, because it creates some uncertainty about government spending and economic momentum. But if you look back at history, right, market don't usually panic for long. Yeah. Most shutdowns get resolved within days, and in Trump's first term, right, it took about a few weeks. Okay, and the underlying drivers like earnings, interest rate, and growth, I would think that they matters more in the mid to long term. And global investors right now, right, are watching two things. Okay, number one, whether this drags on longer than expected, or number two, how it may affect consumer confidence and government service. So if it doesn't drag too long, right, market will likely to strut it off. But if it stretch, we could see more pressure on the dollar, maybe a flight to safe havens like gold and treasuries. But for me personally, right, I would see this as noise rather than structural risk at this point in time. I mean, if past history is anything to go by, I think, while shutdowns make headlines, they rarely shut down the market for too long.
Couple of questions, follow-up questions, if you don't mind here, Dan. One is how long is too long? Because the longest we've seen, I believe, is about 35 days. And the second part of the question is, could it be different this time around given Trump's mass layoff threats as well, and given the problems with the economy that we're seeing, high inflation, high valuations in equity markets as well?
Well, if you were to take the Trump's first term as a benchmark, right, I think anything that is more than 35 weeks will be considered long because
35 days, you mean?
35 days, yes, sorry. 35 days. So if the market will drag on for more than 35 days, right, investors will tend to benchmark them against Trump's first term. So I will take 35 days as a benchmark. And as to whether Trump will do anything different, my personal view is that from what we have seen so far, right, I think we are likely to see it get resolved within the 35 days mark.
Okay, now going back to the Singapore stock market as usual, Dan, how did the STI fare today and any surprises there?
Well, I mean, the STI is really off to a very good start today.
Yeah.
In fact, it started yesterday when it closed at 4,300 points, which is the psychological level that we are looking at. And today we have managed to build on that, gaining about 0.53%. And most of the big cap were up, and the REITs were also showing some upside momentum, likely, riding the wave of this rate cut optimism. And one counter that really caught my eye is SATS. It was up 1.76% today to close at $3.45. It managed a mini breakout above its recent high of $3.43. And this breakout from resistance is always exciting to watch because it's always likely to spark some fresh buying interest.
Okay. Now let's zoom in on some of the counters to watch for today. Then we do have LHN, because LHN, the property management group, said its co-living business Coliwoo has launched this preliminary prospectus for an SGX mainboard listing. How significant of a move is this for the company?
Right, but I would actually call this a brand new news event.
Yeah, we've heard about it.
Because previously, so there was a proposal of this listing way back weeks ago. And back then, right, the share price has already moved up quite strongly to an all-time high of $1.08 when it was first proposed. After that, there was some profit taking, which I think is quite normal because, that the initial excitement has kind of faded. Okay, but now with all these preliminary prospectus officially launched, it is giving investors fresh confidence that the plan is still on track, and that's why we are seeing a new wave of buying demand in the stocks today. Okay, it's a bit like the difference between talking about a big plan and actually putting pen to paper.
Okay.
So I would say that the market should react differently once things feel even more concrete. And from my point of view, right, I think this move is quite significant because co-living is a growth area in Singapore, and demand for this flexible and affordable living space has been quite strong. So I think the spin-off of this Coliwoo would likely to give the business more visibility, and that's it, right? Of course, execution is still the key. So investors will want to see how the IPO is priced, how the business is scaled. But overall, I would see it as a positive step that could broaden LHN appeal beyond being just a property manager.
Now, beyond LHN, then food manufacturing and distribution company Leong Guan today also launched its preliminary document for listing, but on the catalyst board of the SGX. Now, we also saw news about Singapore overtaking London in its Bloomberg ranking of the world's busiest IPO destinations. So what do you make of the recent news surrounding potential listing? Is this enough, or should SGX also attract larger companies and MNCs to also list in the country?
Well, I think we can take that this move, right, signals something more than just isolated deals, okay? So they point to a renewed confidence in SGX as a listing venue, especially for smaller to mid-sized firms that want to tap the local capital market. I think Leong Guan is a very good example. It is not a high-profile name across Asia, but by going for a catalyst listing, right, it shows that regional and domestic companies still see some benefit in accessing the public markets locally, and that gives some depth to the pipeline. And when you see Singapore leapfrog London as in the world busiest IPO ranking, right, it actually amplifies that narrative that, capital is again flowing towards Southeast Asia, and SGX is starting to capture some of that. And as to a question, right, whether it is enough, well, I think in my view, at least it's a good start, okay, but to make the trend more sustainable, as you mentioned, I think SGX may need to attract larger companies and MNCs. Why? Because I think big names will bring in liquidity, global attention, and credibility, which would leave the the entire ecosystem here. So yeah, I would say the current momentum is positive, but I think the real game changer will be when we see some really heavyweight companies choosing Singapore as their listing home.
And if you want to find out more about Leong Guan was one of our early under the radar guest as well. So you can search some of those podcasts on Spotify or on Apple Podcasts. But if you're just tuning in, we're in conversation with Dan Chang, trading representative at PhillipCapital. Well, across the region, Dan, private surveys showed factory activity shrank in most of Asia's major economies in September as signs of a slowdown in U.S. growth and the expected impact of U.S. President Donald Trump's tariffs added to pressure from weak Chinese demand. Now, just to bring out some numbers, if we look at the S&P Global Japan Manufacturing PMI, that fell from 49.7 points in August to 48.5 points in September. Now, if we look at Taiwan, its manufacturing PMI fell from 47.4 points in August to 46.8 points in September. So basically further in the contraction territory. What do you make of the numbers? What do they say about the outlook of the manufacturing sectors in these economies?
Oh, yes, there's a lot of numbers.
A lot of numbers indeed.
Yes. In general, I would think that given these numbers, right, it is very clear that factory across Asia has been slowing down, okay? And as you mentioned, Japan, Taiwan, and Philippines and Malaysia are all contracting, okay? And as we all know, right, anything below 50 means that the activity is actually slowing down, is actually shrinking. And you're right, a lot of these, right, come down to weaker demand from the US and China, plus the impact of tariffs. So export orders are falling, costs are going up, and it's putting pressure on manufacturers. And from my point of view, right, I think it's a bit of a worry. I think it's also a reminder, for companies that it is important to diversify and get creative. I mean, if you are too dependent on one market, right, any hiccups abroad may hit very hard on the company. And for those, right, who really adapt and explore new opportunities, this slowdown could be a chance to really reposition for growth. And I think that is why we are seeing a lot of countries in Asia, are now looking to forge a new friendship, new partnership to strengthen trade ties.
And if we stay in Asia, then Japan's top trade negotiator, Ryosei Akazawa, said this $550 billion investment fund into the U.S., that is a pillar in that U.S.-Japan trade deal, wouldn't affect currency markets. What's your take on the matter? And really, when it comes down to the Japanese yen against the USD or SGD, what are the levels to watch?
Well, personally, I think his comments are meant to reassure the market, to really calm the market. So he's basically telling the market that, not to worry about these US $550 billion investment into the US because, it's part of this US-Japan trade deal, right? Only a very small fraction is expected to actually move as real investment. The rest is more like, loans and guarantees. So it's not the kind of money that will suddenly shake up the currency market. And for the yen, right, the big thing is still, they are still driving it, the US interest rate, the economy data, and the overall market sentiment. Traders are now actually, from what I read, they are watching the 150 level against dollar. That is a key psychological level. And as for the Sing dollar, right, it tends, for Sing dollars, it works a bit differently. It tends to track trade flows and regional stability. And right now, right, with the Sing dollar is around 1.29, I think the near-term range that we are looking at is around 1.28 to about 1.30. And if the yen and global market were to stay calm, I think the Sing dollar should hold steady in that band. So really, I think this fund is important for the long term, but when it comes down to day-to-day currency movement, right, it is mostly business as usual, in my opinion.
Now, before I let you go, Dan, let's take a look at what's happening further away. How Pfizer has secured this reprieve from Trump's long-threatened tariffs on the pharmaceutical industry, and that is by agreeing to slash some of its drug prices by up to 85% and selling directly to the American public. This is a move that other big pharma players are expected to follow. What would this mean for the bottom lines of big pharma firms, and what do they mean for the sector as a whole? What should investors take note of?
Well, I have to say Pfizer has actually made quite a bold move, by agreeing to slash, the drugs price by up to 85%, which I think is quite a lot, and selling directly to consumer through a platform called Trump RX. Okay, and in return, right, they have secured a 3-year reprieve from President Trump's threatened tariff on pharmaceutical imports. And I think this is a very significant shift in how big pharmaceutical operates and could set a new precedent for the industry. For Pfizer, I think this deal is a win, obviously. It avoids the immediate impact of tariff, which could have increased costs and disrupt the supply chains. Instead, they are now taking control by offering lower price directly to consumers, potentially expanding their market reach and improving public perception. However, for the broader pharmaceutical sector, right, this could turn out to be, I would say, a double-edged sword. Mm-hmm. On one hand, right, it set a new standard for pricing, transparency, and consumer access. But on the other hand, it pressures other companies to follow suit, potentially squeezing margin across the whole industry. So investors should really keep an eye on how the other major drug makers respond. Will they follow Pfizer's lead, or will they push back against such significant pricing change? And I think another thing to watch out, of course, is for any regulatory shift that might influence this new pricing model. I mean, we have seen that quite often since Trump took the office. And I think for this, right, is a developing story that could really reshape the whole pharmaceutical landscape.
I see. Lots to watch indeed. Thanks so much for the insights today, Dan. That was Dan Chang, investment specialist and trading representative at PhillipCapital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.